Do you feel like something's off with the economy? You're not alone. Investors around the world are growing increasingly uneasy about the signs coming from the United States. Rising interest rates, persistent inflation, a volatile dollar, mass layoffs, something big is on the horizon. And it's important for you to understand what's at stake. If this topic speaks to you, go ahead and hit the like button, share it with someone who needs to hear this, and subscribe to the channel so you don't miss the next videos. Uncertainty in the U.S. economy. The U.S. economy, long seen as a safe haven, is starting to show cracks, and investors are noticing. The concern isn't just about the numbers. It's also about the lack of direction. Political instability, trade wars, international conflicts, and the ever-growing public debt are all eroding trust, an invisible but essential asset. The intense political divide between Democrats and Republicans slows down critical reforms and creates a sense of gridlock. Without clear leadership and consistent policies, the business environment loses predictability. Investors hate uncertainty by nature. They don't want maybe. They want this is how it's going to be. When the outlook becomes unclear, they flee to safer assets, pull money from the market, and wait. And that's exactly what we're seeing now. This risk aversion has real consequences. Less investment, more market volatility, and constant pressure on the dollar's value. It also fuels pessimism and can trigger short-term speculative moves, adding even more instability. Rising interest and mortgage rates. Another factor rattling the markets is the sharp rise in interest rates and mortgage costs. In the U.S., 30-year mortgage rates have surpassed 7%, the highest level since the early 2000s. That means buying a home today is far more expensive than it was just 2 years ago. This directly impacts the housing market, reducing demand for homes and slowing down the entire industry, from construction companies to home improvement stores. For millions of Americans, homeownership has become out of reach. But why is this happening? Treasury yields, the returns on U.S. government bonds, are going up. This happens when the government has to offer better returns to attract wary investors. But doing so puts pressure on the entire financial system. It's a domino effect. Higher interest rates make credit more expensive, slow down consumption, stall investments, and raise the risk of recession. It affects everyone, from small business owners to large multinational corporations, and drags down growth. Declining trust in Treasury bonds. For decades, U.S. Treasury bonds were seen as the world's safest investment, but that perception is shifting. These days, many investors are demanding higher returns just to feel comfortable holding them. That growing hesitation is a clear sign of distrust, something that would have been unthinkable just a few years ago. When even government bonds need to offer more just to find buyers, it means the perceived risk has increased. Something fundamental is off in the economy. And why is that? It comes down to the U.S. national debt, which has already passed $34 trillion. With such high spending and mounting deficits, investors worry the government may struggle to meet its long-term obligations or end up printing more money, which could lead to inflation and a weaker dollar. It's as if the world's safest asset is starting to lose its reputation for being untouchable. And that changes everything. Systemic risk becomes more real, and fear spreads across all asset classes. Inflation, the dollar, and government measures. Inflation is still a lingering threat in the U.S. economy. Even though it's come down from the 2022 peaks, it's still above the Federal Reserve's 2% target. That inflation eats away at household purchasing power, especially among the middle and lower classes, fueling dissatisfaction and pushing for political and economic change. That adds more uncertainty to the business climate. Add a massive national debt and slow revenue growth, and the government is caught in a tough spot. Cut spending or lower taxes, or try both at once. But while those measures may be politically popular, they can further weaken public finances. Less revenue and less spending don't fix a deeply indebted budget. The dollar, meanwhile, is under pressure. Even though it remains strong against many other currencies, investors know that excessive money printing combined with fiscal instability can gradually erode its value. This potential weakening of the dollar has global consequences, since it's the world's primary reserve currency. If trust in it starts to drop, the impact will be felt across all markets. Rising layoffs. One of the clearest signs that the economy is in trouble is the sharp rise in layoffs. According to a report by Challenger, Gray eChristmas, layoffs have surged more than 200% compared to last year. Tech companies, banks, retailers, and even public institutions are cutting jobs. This reflects a defensive mindset. Companies are bracing for an economic slowdown and cutting costs to preserve profit margins. It's a response to the growing uncertainty. And why does that matter? Because when companies start laying people off, it's a sign they're expecting tough times ahead. More layoffs also mean lower consumer spending, more reliance on government support, and a greater risk of recession. Consumer confidence also takes a hit when layoffs rise. And since consumer spending makes up about 70% of the U.S. economy, that drop has a direct impact on GDP. Companies are cutting back on investments. With so much uncertainty in the air, high interest rates, inflation, political instability, and possible tax changes, many companies are hitting the brakes. Investments in infrastructure, innovation, expansion, and hiring are being put on hold or postponed. This is especially noticeable in sectors like construction, tech, and energy. The business logic is simple. Why invest now if the rules could change at any moment? Better to wait for a clearer scenario before allocating capital more safely. This widespread pause leads to stagnation. Less investment means fewer jobs, less innovation, and slower growth. And that affects the entire economy. If the private sector slows down, the public sector needs to step in. But with government finances already under pressure, keeping that balance is becoming increasingly difficult. Gold as a safe haven asset. Amid all this instability, investors are once again turning to an old favorite, gold. The precious metal is seeing strong inflows thanks to its historic role in preserving value during times of crisis, inflation, and currency depreciation. In recent months, gold prices have surged, with institutional investors increasing their positions in search of safety. Gold doesn't rely on governments, monetary policies, or confidence cycles. When everything else is shaky, gold holds its ground. That's why it has hit record highs in various currencies lately. It serves as a safe haven, an anchor of value in a sea of uncertainty. And for long-term investors, it can be a smart diversification tool, a long-term investment outlook. Despite this worrying landscape, there's another way to look at it, as an opportunity. Periods of volatility and fear often present the best entry points for long-term investors. It's when prices drop, pessimists sell, and the patient build. Some of the greatest fortunes were made during crises. Warren Buffett, for example, famously says we should be greedy when others are fearful. And this might be that moment. The strategy known as ABB, always be buying, becomes even more powerful in times like these. The idea is simple. Invest consistently over time, using low-cost, broad-based vehicles like the SPY and VO ETFs, which track the SEP 500. They offer diversification, stability, and long-term growth. History shows that those who invest with discipline during downturns reap extraordinary rewards when the cycle turns. Time is the best ally of the smart investor. Financial education and discipline. And finally, perhaps the most important takeaway, you need to build financial literacy and emotional discipline. Investing isn't just about knowing where to put your money. It's about knowing how to behave when things get tough. Most people lose money not because they picked bad assets, but because they made decisions driven by fear or greed. Learning to manage your emotions, stay consistent with your contributions, and ignore market noise is what separates winners from those who give up halfway. You have to block out short-term noise, resist herd mentality, and stick to a clear plan with regular contributions and a long-term vision. True financial freedom doesn't come from predicting the future, but from building a solid plan and sticking to it. And that starts with knowledge and action. We're going through a delicate moment in the global economy, and the signs coming from the U.S. are raising concerns. But for those with knowledge and discipline, every crisis carries a hidden opportunity. Stay strong. Invest in yourself, in your financial education, and in a long-term strategy. And remember, it's not the moment that defines your success. It's what you do with it. If this video helped you, leave a like, share your thoughts in the comments, and send it to someone who needs this perspective. Subscribe to the channel so you don't miss what's coming next. Let's move forward together toward prosperity. Money bag chart increasing.